Yo, what's up guys? It's your boy Ray back with another very special, powerful video. And in today's video, I want to talk to you guys about this new tax proposal that was just released yesterday, or at least that's when I first caught wind of this new tax proposal last night. And guys, this tax proposal is a big deal, and if it goes through, could possibly be what's going to give us that $2 trillion in revenue that's needed to complete this Biden infrastructure plan. But let's break this down, guys. I got the Wall Street Journal article pulled up here. Senator Ron Wyden is the legend today. He's a hero today, guys. Senator Ron Wyden plans would eliminate billionaires' ability to defer capital gains tax. So let's just break this down, right? So this tax proposal will only impact and affect individuals who have a $1 billion net worth or have made over $100 million in the past 3 consecutive years, right? So this is literally a tax proposal for the top 1% of the 1%. We're talking about our billionaires, our Elon Musk, our Jeff Bezos, even our Jay-Z's out there, right? I don't know if he has a $1 billion net worth, but as far as I'm concerned, I think he is a billionaire, so he probably does. But this tax proposal is huge, man. And I think, reading through this article, annual income taxes of about $700 billion of unsold publicly traded assets such as stocks. So this proposal arrives as Democrats are struggling to find up to $2 trillion over a decade to cover the cost of their agenda. Don't forget, Biden's infrastructure plan bill was a $6 trillion plan. That means it would require $6 trillion in revenue to bring to life Biden's infrastructure plans. And right now, we just don't have that, guys. Federal government does not have enough money to cover these expenses, so the money and the revenue has to come from somewhere. This is a proposal that would ultimately take that money from the top 1% of the 1%, the billionaires out there. So let's break down some of the key details of this plan. So really, this plan is designed to tax unrealized gains. Now, guys, up to this point, first off, let me define what a unrealized gain is, right? So when you buy a stock and you hold that stock, any gains that accumulate in that stock is considered an unrealized gain, and up to this point was not able to be taxed. You only generate a tax liability on a gain when you sell the stock, and at that point, when you sell the stock, it no longer becomes an unrealized gain. It becomes a realized gain and is subject to either long-term capital gains tax or short-term capital gains tax, depending on if you held that stock for greater than a year or less than a year. So this tax proposal is targeting unrealized gains, so gains that have not yet been realized in securities that have not yet been sold. And to me, that's really the biggest part of this. That's really the most factor of this, is they're actually going after and attacking unrealized gains, not realized gains, unrealized gains. So basically, just read through this article a little bit. The proposal, if implemented, would likely generate a large chunk of revenue in the first few years from company founders who would pay tax on the high value of their businesses against a zero or very low cost basis. That includes people who started companies in garages and dorm rooms and turned them into tech giants. That's a straight shot at our buddy Jeff Bezos. It's a straight shot at Bezos right there. But let's see. I want to get into the details of this. Okay, so here's how the Wyden tax proposal would work. It would start in 2022 and apply to people who have a net worth of $1 billion or annual income of $100 million for the three prior consecutive years. So that would be 2019, 2020, and 2021 to start. And they would remain in this new tax system unless they had 3 straight years in which their assets and income fell below half of those thresholds. So they would remain in this tax system unless, let's just say in 2023, 2024, and 2025, their assets and their income fell below half of those thresholds. So moving on. First, as the new system starts, affected people would have to pay a tax as if they had sold their publicly traded assets. Let me read that to you guys again. As the new system starts, affected people, meaning people with a net worth of $1 billion or more, or people who make annual income of $100 million for the past 3 consecutive years, those people would have to pay a tax as if they had sold their publicly traded assets. So once again, back to those realized and unrealized gains, they would have to pay a tax as if they had sold and realized those gains. They even give an example in this article, and I'm going to read it. So someone who bought $2 billion worth of stock in 2010 that was now worth $20 billion. So if you had bought $2 billion worth of stock in 2010 and it's now worth $20 billion, they would have $18 billion added to their annual income and taxed at the top long-term capital gains rate of 23.8%. So even if a billionaire bought stock back in 2010 valued at $2 billion, and that stock now in 2021, 11 years later, well 22 when this tax proposal will be implemented, so 12 years later, that stock is worth $20 billion. But the key here is that they haven't sold that stock, right? So that stock is now worth $20 billion and they still are holding the stock. They haven't sold it. So it's a $12 billion, it's an $18 billion, it's an $18 billion, right? So $2 billion to $20 billion, that's $18 billion would be added to their income in the year of 2022, would be added to their income and taxed that year at the top long-term capital gains rate of 23.8%. That would generate a $4 billion initial tax that could be paid over a 5-year period. So let that sink in, guys. If you bought securities valued at $2 billion back in 2010, and that stock is now worth $20 billion, so that's an $18 billion difference, but you have not sold it, you would be liable for that $18 billion difference if this tax proposal was put into place. You would be liable for the $18 billion difference the day that tax proposal gets put into place. And that would lead to a $4.3 billion tax bill that could be paid over a 5-year period. So that's crazy. Let's read on. And it gets even wilder, right? So not only would they have to pay for those unrealized gains previously, then each year after, they would have to pay a tax on the gain in value for that year. So let's say in 2023, the stock goes up in value, they're going to be liable to pay tax on that stock, on that capital gain increase as well. So guys, really let that sink in, right? So if look, if you buy, let's say they bought stock in 2022, and then at the end of the year, that stock shot up $2 million, they would be taxed. They'd be taxed on that $2 million capital gains. So that's what we're talking about here. Like, they would be they're going to be taxed on unrealized capital gains, and like, that kind of sucks, man. Like, I mean, I'm sure it's not that big of a deal to those guys. When you're a billionaire, when you're in that status, it's like you can deal with, small taxation like that, whatever. But I don't know, man, this is crazy. So there's a couple more features to this tax proposal bill that I'm going to read. So we just talked about the rules associated with non-traded assets, like non-traded stocks and bonds, like non-traded stocks. But there's also a different set of rules that applies to, or there's a different set of rules that applies to non-traded assets such as real estate and closely held businesses. So let's see what this is about. So for assets such as real estate and closely held businesses, those gains wouldn't be taxed each year like unrealized gains associated with stocks, avoiding the difficulty of assessing value annually. So capital gains in real estate and closely held businesses would not be taxed each year. Instead, they would be taxed as capital gains when sold or transferred, or when the person dies. So when the real estate is sold or transferred, that real estate would be taxed at capital gains, or when the person dies, it would also be taxed. Without any other change, that rule would create a tax preference for such assets over annually taxed publicly traded stocks, because a tax on real estate and businesses could be deferred. Oh, thank you, federal government. Thank you for not taxing me for not selling things, right? Like, anyway, so basically what they're saying is, unlike stocks that would be taxed anytime a capital gains was generated, whether the stock was sold or not, real estate and businesses would only be taxed when they're either sold or the person is deceased, right? So real estate and more tangible assets operate a little bit differently, but here's the kicker, right? So I'm going to get back to this article. Without any other change, that rule would create a tax preference for such assets over annually taxed publicly traded stocks, because the tax on real estate and businesses could be deferred. However, guys, here's the kicker. The widened plan includes an interest charge on non-traded assets such as real estate, and that is designed to equalize the burden on those assets with the burden on publicly traded assets. So there would be an interest charge on assets such as real estate and businesses. So they're not going to be taxed every year, but there will be an interest charge on these assets. So let's learn a little bit more about this interest charge. So the proposal would add the interest charge to the regular tax rate, but cap the total tax at 49% of the gain in value. So let me read that again. The proposal would add the interest charge to the regular tax rate, but cap the total tax at 49% of the gain in value. The cap plus the way the interest is calculated could give people an incentive to shift to non-traded assets, but the rules for losses are less generous than for publicly traded assets. I'm not really understanding this new interest thing. So comment below if you guys understand it a little bit better. The proposal would add the interest charge to the regular tax rate, but cap the total tax at 49. Are you talking about the regular marginal tax rate? I don't know. So they said, let me go back up again. Instead, there will be taxed as capital gains when sold or transferred. So they're going to be taxed at capital gains when sold or transferred, but cap the total tax at 49%. Look, guys, someone comment below if you better understand this new interest thing on this new tax proposal. Comment below, let me know. The Wyndham plan includes a series of rules designed to limit billionaires' ability to escape the tax, and they would be tested quickly, as well as the well-financed taxpayers battle with the IRS. Another key thing about this is gifts and bequests, except to spouses, will be considered as triggering a capital gains tax. This is new as well. So gifts and bequests that go to charity and to spouses would not trigger capital gains tax, but any other gifts and bequests that do not go to spouses or that do not go to charities would trigger a capital gains tax. So that's new and big news as well, guys. Many trusts will be subject to this tax system if they had at least 100 million assets or 10 million income. Those lower thresholds aim to preventing billionaires from splitting their assets among trusts to avoid the tax. And that's pretty much the end of this article, guys. But so that's a new tax proposal in a nutshell. I highly recommend that you guys go and read up on this on your own. There's still a lot of components to this tax proposal that I don't truly understand at this time. It's going to require it's going to require a little bit more due diligence on my end. Like that interest charge thing on real estate and businesses is something I definitely want to look into a little bit more. But I think the most shocking thing about this new tax proposal is the tax on unrealized gains of publicly traded assets on your stocks, right? So the days of holding securities for 10 plus years and just accumulating capital gains on these securities without facing any tax liability is over for these billionaires, guys. And I'm gonna be honest with you. I know I tend to lean a little bit more conservative on certain fiscal and monetary policies, guys. But I don't know if I'm that upset about this one right here. Considering a lot of the tax haven benefits that exist for these billionaires, you know, a lot of these guys aren't really paying a lot in taxes. So this could wound up being very beneficial for the economy. I don't know if our government probably will screw it up like they screw a lot of things up. But I don't know, guys. Comment below. Let me know what you guys think about this new tax proposal. Excuse me. Let me know what you guys think about this new tax proposal. Are you an advocate of it? Do you think it's stupid? Do you think the government just sucks in general? Do you believe in lower taxes? Do you believe that taxes shouldn't exist at all? Comment below. Let me know what you guys think about this new tax proposal. I'm curious to get your thoughts on it. I'm gonna, keep digging into this, figure out more about this interest stuff. But I do think it's crazy about the unrealized gains. I think that's the biggest shocker for me. Let me know what you guys think. Your boy Ray. I'm out of here. More videos like this coming soon. Peace.